Okay, we're live. So thank you very much and welcome to this session of WAPI Virtual Summit 2020, where we are going to be sort of focusing on lessons from COVID-19, the End SARS campaign, and a business lockdown. I have a very distinguished panel of top-class real estate professionals in Nigeria and from further afield. So without further ado, let me introduce the panel. Firstly, let me introduce myself. My name is Bolaji Edu. I'm the CEO of Grow Nigeria. We have with me Frank Okasun, who is a senior partner of Knight Frank Nigeria. Tola Akinami, who's the head real estate finance West Africa for Stanbic IBTC Capital. And finally, but by no means least, we have Paul Onuwanibe, who is a group CEO, Landmark Africa Group, UK. So I just want to thank you all for your time, and we look forward to a very interesting discussion. It's obviously been a very interesting time in the global economy and also in the Nigerian economy as well. The COVID pandemic has led to sort of shutdowns all across the world. But in Nigeria, we've also had the additional impact coming from the End SARS campaign, as well as the impact on our the currency and also on our major export, our major source of export revenue, which is the oil price. With all of those, potential headwinds for us, I think it'll just be sort of good to understand how the panelists are, navigating those headwinds, what they have learned, and, how they are looking to do things differently in the future. So Paul, I will start with you. So Paul, I'll start with you. From a developer standpoint, what has been the impact of the pandemic and the ensuing contraction in business and economic activity following pandemic response strategies in the market? How have you and how do you continue to weather the storm in this difficult climate? What are the risk opportunities you can identify going forward?
No, thank you, Bolaji, and thanks a lot for having me on stage, and thanks for making me the first to speak. That's good in a way, because I'll be able to learn from Frank and Tola when they're speaking. Gosh, so as you know, there's been a multiplicity of events. So the pandemic is one thing, but almost like three black swan events happened at the same time. So we had the commodity crash, which created all sorts of foreign currency issues in our parts of the world, in West Africa. We obviously had the pandemic, and the lockdown on top of the pandemic created other issues. More recently, we had the End SARS, the protests. And those three things have combined, to create a very turbulent real estate platform or arena. How we cope? So, I mean, obviously, nobody predicted 2 out of the 3, so it was quite difficult. So we've had to have literally a mindset shift, just in terms of how we deliver our service. So there were 4 things, and someone once told me this. There are 4 things that one has to look at when there are black swan events. One obviously is communication. You need to be able to communicate. You need to get your information. You need to get real information. 2 is you need to shore up your credit lines, ensure that you have the money to do the things you want to do during that period of time, and you conserve as well. Conserve your cash. Make sure you have enough credit. 3 is what they call it the 4 C's. So 3 is the colleagues. So we just made sure that we locked down the number of people within our site. We made sure we kept in touch with our clients and our colleagues, and just tried to keep things turning over. And then lastly, but certainly not the least, is the customer. So everybody has a shock, and it's sort of our duty and our responsibility to ensure that the customers are there through the pandemic, because a dead customer or a dead business is no good to us, and that usually is a difficult thing because you have your own responsibilities with regards to finance. So there are a number of things we basically had to introduce. Now, from a pandemic specific point of view, there was a health issue, and some of you may know that we actually signed up to creating an isolation center in our place on our platform for two reasons. One is that we felt there was a need to give back to the community, and two is we knew that for a long period of time that we couldn't run our sort of mixed use business, leisure, lifestyle development. So those two things combined to enable us to do this. So it also kept us busy as well. It kept people coming through the door, and enabled us to feel good about ourselves, contributing to society. So we did that. In terms of coping after the isolation center, so the isolation center, we wound it down in July as some of the effects of the pandemic began to recede. But the economic effects still stay on, because a lot of our business was closed for 9 months. Occupancies went down, cash flows went down. So supply chain was quite difficult because we were building two things during that period of time. So we had to look at our supply risk issues. We had to look at the demand risk issues, because even though we still have 86% of our clients still there, they're actually they haven't resumed. So they're not really at work yet. So you don't really know when they come back, whether there are conversations you're going to have with them in terms of, reducing space and stuff. So, there's still a demand risk, and we're still in it. There's a political risk, as NSAS has told us, because of the pandemic. There are a lot of people who either don't have jobs, and a lot of people have been at home and bottled up for some time. And, there's a class in society that has suffered, and there's bound to be a reaction to that, and one has to pay attention to that. So there's also that risk. Then there's the investment risk, as we have a whole multitude of investors, and we have to keep everybody happy at the same time. Some of them are foreign currency based, and some of them are Naira based, and everybody has to be kept sort of happy. So communication, transparency, logic in one's business, things like that are important.
Yeah, I mean, it seems as though we had just been, going through the perfect storm, as the saying is. The global, everyone in the world has been impacted by COVID-19, to a greater or lesser extent, and Nigeria is just it's no different from that. But obviously, there are additional things that are being sort of impacted at Nigeria, and that given that real estate that we all love is very much, at least on the cost side of real estate, is very much a dollar a dollar business. Then and anything that is sort of impacting on sort of the dollar on the FX is going to sort of have a huge impact. And then also we've seen whether there is whether the investor appetite for Nigeria, and not just real estate, but for Nigeria in general, whether that is still as strong as it was 24 months ago. Frank, your camera is off, so please could you turn your camera on?
Can you get me?
Yes, we can see you now, Frank.
Okay, good.
We can see you. So, the next question is, is going to be directed at you. Okay. And so I'm sure that people would like to sort of see you as well. So, so we'll start. From a transaction perspective, I assume these are lettings, sales, and all the others. what can you identify with the major challenges you have faced this year as a result of the coronavirus pandemic?
Can you come back again? You said what of the transaction?
Yeah, so from, I mean, obviously as, as Knight Frank, you do a lot of leasing. I'm sure that you sell a lot of property and land. Because of the pandemic, what are the major challenges that you and Knight Frank have experienced from that? And are there any strategies that you have put in place, to sort of try and mitigate those challenges?
Well, thank you very much. Thank you for having me in this section. Thanks, Paul. I benefited from what you said earlier too. As Knight Frank, our transactions are really in real estate. So the major challenge that we had there was quite, real estate is a physical assets, and it requires a lot of physical inspections for any good transaction to be closed. So during the lockdown, during the pandemic, there was lack of no movement and no inspections. And without inspections, you can't create any transactions. So there was a glut in that. And again, there was a lot of requests from our clients, from rent reductions, rent holidays, and in some cases they were asking for delayed payments, and it cut across both the residential and commercial leases. And it affects transactions. And there were apathy on the part of investors as well, and will be tenants. Big key challenges that were affecting the business at that time. And there was outright requests for some of the tenants to vacate just like that because of the pandemic. So what do? We had to be able to take good precaution at that time. And as managing agents to some of these properties, which you yourself, you are in these transactions as well, there were contracts, unserviceable contracts on the part of service providers, like the lift and erect things. Some of those contracts were just laid down. And security threats again. Heavy security threats to most of the retail outlets. I know it affects some of most of the mall you are managing. So there were heavy security threats. So some of these challenges were very, very key to us. So, but what do? We had to re-strategize. We were very proactive. From rent reductions, we start having meetings with our clients, network meetings, trying to make them understand, analyze the transactions for them. It's better for them to have clients in this property than to lose them. And you know what it means not to have tenants in the property. So some of them granted those transactions for us. Most of those properties, some of the big commercial transactions. Then technology, we were proactive about that. Lack of inspections, so we had to adapt into technology, bring in some media into our transactions, more videos on virtual inspections and meetings. Those that take into considerations some conversations and things we're able to do some closing in some leasing, but not really sales. Then those areas, those contracts, we had to go back to the service line agreements. We had to renew, we had to renegotiate in order to be able to have a good service charge account to be able to run those facilities. So we put those things in place and ensure that we don't lose guards. Then on the security issues, what we did, we reworked apart from the police security and corporate guards we have in most of those properties, we had to rework some of the strategies in security network. What we did was in some areas that were exposed to these street urchins and erect things during the COVID period, we started feeding these urchins and these people that are unemployed in those areas, creating things for them, giving them money, And when some of these things happened of recent, some of these properties were protected. We had no issues with vandalizations because the same people would be the one to go and vandalize those places. So we took those things into considerations. We call them local insurance. But we're able to put those things in place. Then the other areas we looked at were the issues of the rents. Like I said earlier on, we ensured that we had those rent holidays and the rebates and reduced rents. So we kept those strategies in place to be able to get those challenges we had earlier on.
Yes, I mean, I know it's also been a very tough year, both for investors and owners, as well as for agents as well. You know, we've seen, you know, footfall in some malls, you know, fall by, you know, over 50%. And, you know, just when they were beginning to come back again, you know, we now had the NSARS sort of challenges, which sort of send them back again. And then also, as Paul said earlier, you know, a lot of the, you know, a lot of office buildings are, you know, are still vacant. You know, yes, they may be fully leased, but the tenants in there aren't bringing their, you know, they aren't bringing their staff back into, you know, back into work. So, you know, at times you realize whether there is still a lot of, you know, a lot of pain to be felt, or whether we have gone through the worst. But Frank, still staying with you, you know, we know that Knight Frank are, you know, sort of cover all the sectors and have a good, you know, as well. Is there any sort of particular sector that you feel has been hardest hit, you know, because of the, you know, because of the three challenges that we mentioned?
Yes, Bolaji, thank you very much. You know, all the sectors were hit, but the strongest one that was mostly hit was the entertainment one, the hospitality, and the retail and part of the commercial offices areas. But the entertainment industries were the most hit because of the restrictions, and businesses were stopped for those people, or like the residential, because there was less impact on them because people have to be at home. So you find people looking for better homes, good gated areas for them to stay, and bigger homes because of the COVID period. And we found that transactions came up in especially bigger residential area and good gated communities where you have things being put in place properly well. So we had those ones, we had transactions still going in those areas. And those were our core where we're making a lot of transactions in that area. But in big commercials, most offices, some of the leases were revoked. Some of the banks just said, you know what, close this branch, close that branch. And we ourselves, we even adopt a way of living in our offices. So people were working from homes, social distances, and offices were reconfigured, you know, and the entertainment industries, the retail business, the commercials were hard hits. But the residentials, they had it go. They had it good. And they had it good. They had it good. Good residentials, they had it good. So that's where I call. We were making good transactions from.
Okay. Thank you. Yeah, thank you very much for that. So just you know, turning to Tola, I mean, obviously real estate, you know, in any market that you go to geographically or from a sectoral perspective, you know, cannot operate without, you know, without finance, and in particular without sort of debt finance, you know, whether that's people looking to, you know, buy a house, people looking to make investments, or, you know, whether they are, large scale sort of commercial developers like Paul on this panel. So, being the finance guru here, Tola, with, yourself and Stanbic have had a very long and distinguished track record in Nigeria and across Africa as a whole, I should say, of lending to some of the sort of pioneer developments in Nigeria, Ghana, and other countries. So you have seen other cycles, other business cycles. I know that you and I have talked about this in the past, but you've seen other business cycles, but this one is very different in my view. So, so what has been the impact of the coronavirus pandemic on commercial real estate lending? And do you see any recovery in the market that could potentially reverse any negative effects?
Thank you very much, Bolaji, and thanks to and good feedback by Paul as well as Frank, who are partners in the industry. So I think this is a useful panel session. And I think there've been quite a few this year, as well. Just looking at the impact of what has been a stressed year. Just to add to Paul, 3 points. And I feel there was a fourth one, which maybe might not pervade the whole sector, but it was quite a shaker within retail, and that relates to the ShopRite's potential divestment of their stakeholding, within the continent, and which we've seen some of that happen. So that's also quite a significant event. Overall, from a commercial real estate lending perspective, I think it's been, the first thing is that you take a long-term view on structuring of the debts across these assets. So while the critical thing has then been a difficult year, one has to first of all consider the long-term sustainability of cash flows, of the asset resilience of the various assets. So the reality is that, given some of the difficulties that one has faced, it really means having to have a sit down with your clients, with developers, and really bottoming out on what the direct impact has been in terms of the impact on the cash flow and consequently serviceability of debt. So I think on understanding that and going into the detail, which I think we've had to do right from March, when we began to see the impact across FX illiquidity, and really Q2, where you had the impact of the lockdown and consequently landlords giving forbearance to tenants, mainly in the retail space. You haven't seen that in the office segment as such. So to the question you asked, Frank, in terms of where the greater impact has been, is really around the retail segment mostly. That's where it has been felt, because they thrive on consumer spending, and with the impact of the lockdown, ability to trade, you felt that mostly within Q2. So working with our clients, looking at the cash flows, one would then need to look for certain forbearances and structure to ensure that, yes, the assets continue to trade, resilience is built, and you begin to see cash flows come through. And I think, given where we are in November, we've seen that resilience come through across a number of assets. Where in the last quarter, Q3, you're seeing the rental or the rental collection levels going up compared to what you then saw in Q2. So you're seeing a reversion of some of those trends. Still difficult times. One is not disputing that fact, but clearly we've seen some resilience built in. We're working together with clients, landlords, various stakeholders in the industry to prefer workable solutions to ensure that assets remain resilient and cash flows are sustainable. The greater impact beyond COVID, because COVID is indeed a short-term view, give and compare that to the long-term sustainability nature of the real estate asset class, was then the impact of the civil unrest, which again impacted retail massively, but we've begun to see some come back in terms of the assets that were hit. Tenants, were most hit, and really sad for some of the losses that ensued. But with the right support from landlords, it's hopeful that you'll see many of those tenants coming back to trading. We've already seen some of that happen in the more stronger hit assets, but it would take a bit of maybe in the next 1 to 3 months, we'll see some of that resilience coming back. So just linking that, given what has happened, we remain supportive of the sector, of the asset class. We want to work with sponsors that understand the asset class, have the track record, have the financial strength to support the assets if and when needed, and working together with them. We're able to prefer and structure solutions that just help to mitigate some of the short-term impact, and as well as deliver long-term value.
Okay, thank you very much for that, Tola. I just have a further sort of follow-up question for you. Obviously, I'm glad that you mentioned cash flow, because ultimately, in the short term, real estate is a cash flow business. In the longer term, yes, capital values appreciation sort of comes into it, but in the short term, it's very much a sort of cash flow business. Are there any sort of changes that you're making to how you underwrite your underwrite the cash flows when you're looking at opportunities, because of the because of the recession and the challenges that we are facing at the moment?
Yeah, I wouldn't say that, the principles of real estate are everlasting. And when it's everlasting, it's, you're either in the market where there is bullishness, be more flexible, and when the market is bearish, be a bit more conservative or bearish in your outlook. But I think the key parameters are driven around sponsors, their track record, the ability to support the assets, then the resilience of the asset in itself. So there's no one size fits all. So it speaks to the location of the asset, the stabilization within that asset itself, tenant mix, ability to the strength of the rental areas, and it differs from asset to asset. So you need to take a asset specific view in then working to what is best. So I've said 3 things: is the sponsor, is the asset, and then is the cash flow sustainability, which is a factor that co-mingles to then drive the specific solution that you.
Sorry, my apologies. I seem to have lost Tola very briefly.
Okay, can you hear me?
Hello, Paul. Can you hear me?
Yes, I can hear you, Bolaji, and I can hear Tola too.
Okay.
Okay, great. So I'll just rehash those 3 points that I said. So the views remain: sponsors consideration, asset specific consideration, and then the cash flow sustainability. And I think the key point there is that those 3 factors have to mingle. The type of sponsors that you support, the specific asset nuances, which then drives the resilience around that asset class. And there's no one size fits all. And then the cash flow sustainability and intrinsic geostructuring nuances that are embedded into the transaction helps to drive the type of solution that you will see. What we're beginning to also see emerge is rather than take on, and it's all part of how the market is maturing, where you're seeing consolidation activities. So you're then able to drive portfolio type structures where you have the benefit of a portfolio of assets. I think we've just lost Bolaji. Where you have a portfolio of assets, and you're able to then wrap deal structuring solutions that benefit a particular asset that may be struggling, and getting the benefit of the cash flows from the other better performing assets. So I think those are part of the key metrics I want us to bring together to ensure that you continue to make transactions. So I'll just leave it at that point, and happy to take other views.
Yeah, so Tola, you mentioned that one of the major industries or sectors that was hurt was retail, and yes, I'll agree with you to a large extent, but I think the biggest sector that was hurt was basically the hospitality sector, because the hospitality sector, which I would include the F&B platforms, they encourage mingling, and this whole pandemic was all about social distancing. So they've first of all been closed for the longest. They were fully closed completely. I mean, retail shops were closed for a very short period of time. The problem was really footfall in the malls. So just the unwillingness for people to take the risks to go out to shop. But the food and beverage organizations, we have we have a convention center. It opened last week. It's been closed for 10 months. There are other sectors that have been hurt quite critically. How they'll recover will require a lot of political will, by the way. One of the things that we've learned from Black Swan events is that you can't paper over the cracks. You don't just come out of it. Normally, the market doesn't reverse it the same way as a commodity collapse. The market can reverse, or just even regulatory tyranny. The market can reverse that. But the Black Swan event, you have to trade out of it, and you need a lot of help. So there needs to be strong political will. There needs to be a real willingness from the government to engage with the private sector. All the things that we talk about, selfless leadership, both in the private sector and the government sector. There has to be a real culture of service. So there are a lot of things to be done. Right now, I'm actually sitting in the UK, and by the way, it's not perfect over here by any stretch of the imagination, and they're probably worse hit on COVID. But some of the things that the governments are doing to ensure that the private sector survive are commendable. First of all, they're paying 80% of the salaries of everybody who earns below a certain amount. That in itself it helps keep people engaged and employed and in play in terms of the consumer markets. They're lending, £50,000 per head to anybody who wants to ask, irrespective of credit history, irrespective of collateral. Again, for businesses to wind out. And they've unraveled a lot of sort of the complicated tax metrics and relaxed a lot of what I like to call the regulatory tyranny. So we as a body, as we say, Balaji is back. Balaji, we're discussing without you, but
Paul did a very good job, does moderating.
Yes, thank you, and so I do apologize for that. I'm not sure what the problem is, but I'm glad to be back. Anyway, so I did hear everything that everyone was saying, so I was able to hear you, even though you people were not able to sort of hear or see me.
Tola, is he there?
Yes. So yeah, Tola is still here.
Tola.
Yeah.
Sorry.
Okay.
Okay.
So,
okay. Because the conversation with Paul was beginning to be more interesting, because Paul was quite right by saying hospitality was basically, to what I said earlier, was hit because the retail was for a short time, and and you find most of the hotels and the event centers just got opened office and now, but people are still they still have parties going there. People are very scared. And with the second rise coming up now, people have been very skeptical because you hear what is going on in the market. You know, or we had an event that happened, whether it was in Ibadan or something like that. There was a party in an event, and about 100 people got the contact, and some people passed on. So people are still very wary. People are still very wary. People are still very careful. But even most of the retail outlets, people still go there, get themselves with bags and everything, shop and find your way. You know, but how many of the hotels, even in Transcorp today, they still kill people? How many people, even you don't have more than 30-40%, their workforce is reduced? Is it a co-hotel you want? Will you go to the convention center in the co-hotel now for any event? No, not at all.
So, you know, leading on that, Frank, you know, I completely agree. And I think, Bolaji, hopefully we haven't gone completely off tangent. But
no, it's very interesting. So,
yeah, it's right.
I think there needs to be a mindset shift in real estate. The good thing about real estate, by the way, is that it's a long ball game. So we're not trading apples and oranges. You know, we're not here for a few weeks, a few months, or not even a few years. You know, we're here for eternity. We pass it on, right? So I think there needs to be complete change, and I believe that the real estate industry will be fundamentally affected a lot more than people think. People think that this is a little aberration. A year or two, we'll trade out of it and recover. I don't think so. I think a lot of things change. The way the sectors change, the way people approach real estate changes. I think we need to begin to, you know, we need to recalibrate. Basically, we need to introduce and embrace technology to a better degree. I mean, sustainability issues need to be brought to the fore. Our space planning, our flexibility in terms of different sectors needs to change. Even the way the regulation of real estate in terms of permissions and permits and stuff needs to change. I think the tax environment around real estate needs to change incredibly. The mechanization of producing real estate and the supply chain. I think, you know, if there are enough wise people that make decisions in government, then even you know, the fact that we import 80% of our real estate raw materials in well, certainly Nigeria and to a larger extent in West Africa. We need to begin to look at how not only can we use local, but the things that we use foreign, how we bring them in with much less tax, and because all these things impact on the end user. So I think real estate is in for a fundamental seismic shift. And I
agree with you. I agree with you totally, Paul. I mean, it's very clear that things are not going to go back to the way that they were before. And you know, some of these changes are, were happening, you know, even before COVID, but COVID-19 has accelerated them sort of very quickly. So, you know, everyone has, companies have demonstrated that, you know, that they're able to sort of work remotely. So there will be a real shift in how people view the office. You know, will they need to have everyone in the office every day, or are they going to look at the ways they're going to operate? In the same way that, in the same way that, especially in London, where you are, Paul, and in other countries like France and and the US, where the rise of e-commerce has absolutely, it was always increasing. But what we've seen in the increase which we've seen in the last 9 months has been incredible. Yeah. And you have to sort of ask yourself: Are people going to rush back to the shops even when we do have a vaccine? We pray that that will come sooner rather than later. But even when we do have a vaccine, do we feel that people will now rush back to the shops and operate how they were operating before, or have people got used to sort of clicking on Amazon and within 24 hours and anything that they want can be delivered to their front door? So it's not going to change. it's not going to go back to the way that it did to how it was before, and everyone needs to be mindful of that. But the great thing about real estate is that it's constantly evolving, and this is a question that for everyone, sort of going forward, is that across the world we have economists talking about V-shaped recoveries, U-shaped recoveries, L-shaped recoveries. And the most recent letter to get a lot of interest is a K-shaped recovery, which is obviously certain sectors which are bouncing back quickly, and then other sectors which are going to continue to decline. And I think that we discussed it here. The distribution and the logistics sectors are probably going to be the ones that will bounce back very quickly, and then maybe some of the hospitality sectors might still continue to sort of decline. But sort of speaking to everyone, when do you think we will see the bottom of the market, and which of these V, L, U, or K do you agree with?
Can I go?
Yes, anyone can answer that.
Yeah. So I think just to close up on the hospitality versus retail conversations, I mean, it's not in doubt what the impact on hospitality was. I think my reference was to commercial real estate, and in commercial real estate, that speaks more to offices and retail. So there isn't any doubt about the direct impact on the hospitality sector. But I think what comes home, and is that, and but you also made the point. Real estate is a permanent asset class, and if you go through various levels of evolution, will C-19 or COVID-19 have its impact on how that shapes out? Clearly, I'm beginning to see that. In terms of the shape of a recovery, it differs from market to market, because I might say market to market geography. So our own evolution will differ from Europe, will differ from America, will differ from Asia. Also in Africa, what we've seen is that the impact, on various asset classes differ. That's the reality. And so whilst there's a general theme, I think what's also important is understanding, how it begins to impact a certain demography, a certain location, vis-a-vis what their needs are. And if you want to break it down, because if you think about the office space, people are working from home, people are working remotely. My sense, and this is Tola speaking, is that yes, there'll be greater flight and to flexi work, but at the same time, there are companies that work daily during COVID. I know a company that does a test for his staff weekly. So people are learning to work in various ways. You go out to a restaurant to eat now, and you're basically washing your hands before you get in. So it seems to be the new normal. So I think things would evolve. Would there be rationalization or space requirement? Bringing it home to our market, the offices where there is some demand or some demand and vis-a-vis comparing that to the supply in the market and even new supply that is coming in. I think one would need to start to think about how to rationalize that space need, and if there are opportunities to redevelop those assets, and I think there's that possibility where you can have mixed-use precinct, have some office space within that development, have some residential space, have some retail. So that way you're then able to mitigate some of the excess demand that you might see. Demand is also then related to economic evolution. And what I mean by economic evolution is if we see the kind of economic growth that we need to see in our market, then that begins to change the paradigm. Even within this window or this period, what we've also seen is actually demand by technology firms. I mean, in Ghana and in Nigeria, we've seen 1 or 2 firms come up to take about 2,000 square meters space. So, and that's despite all what has happened. So I think the impact would differ, and it's not widespread. Will the asset class evolve? It will evolve, and we need to make use of how life is evolving, the technology that we're seeing, in ensuring that there's greater value created within this asset class.
Okay.
Yes, very, very well spoken, Tola. My old professor in real estate used to say something to me. He used to say there are no roses without thorns. In order to really enjoy something that's sort of beautiful and pleasurable, you must endure something that's difficult and painful. So maybe that's what we've done over the last sort of 9 to 10 months. But unlike the trend of this conversation, where we're talking about a recovery, whether it's UKV, I don't think we should be talking in terms of recovery. I think there's going to be a seismic shift. I think we're talking about the recalibration in real estate. We won't see it yet. Many people will try to trade out of it, but I think there will be a complete recalibration. I think you'll find out that the single sector story is dead, and if it doesn't die in the next 2 years, it will be dead in the next 5 years. So all those buildings that stand alone as an office or as a residential building or as a leisure complex, they're dead. I think there'll be a big move over a period of time towards sort of mixed use. The boundaries between work and home are being collapsed, right? So a premium is now going to be placed on leisure and that transition between work and home. Lifestyles will change for good, right? So we're not really talking about wider corridors, touchless doors, ability to wash one's hands and stuff. We're talking about something a lot more fundamental in real estate. And agreed, as you said, it's a permanent asset class. So it's not going to take place over a year or two. I mean, it will be a gradual shift, but the advantage and disadvantage of real estate is the people who build today for the future of 5-10 years time. The pain is the next 4 or 5 years, but the gain is after that. So as long as you have sort of patient funding, but I really do think when you were speaking, Tola, I was writing down a few things, and just thinking where will the seismic shift happen? I think access requirements. I think there'll be a flight for security. People want more to do in case there's COVID-20, COVID-21. What has happened to us in COVID-19? They still don't even know. We talk about this vaccine as if it's a magic wand. The vaccine is for COVID-19. COVID-19 mutates. Bolaji, you lived in the UK most of your life. The flu, people take the flu vaccine here. Every year there's a new vaccine for the flu, right? Because it mutates. Yeah. So this COVID-19 vaccines for COVID-19, which by the way is almost 2 years ago now, right? So who knows what will be happening in terms, and real estate has to respond because our children have to go to school. We have to go to hospitals, we have to live in a place, and we have to have that flexibility to work in a place. So whether offices will become homes and homes will become offices, those boundaries, I think, will melt away. Those of us that react to it will be important. I think infrastructure, in the countries in West Africa, infrastructure will be a real premium. We need to begin to develop and improve on our infrastructure, because during lockdowns, you see the benefit or the pain of lack of infrastructure, whether it's power, clean water, sewage, or just road access. And recreation, the minute the lockdown ended and people were sort of released, the amount of recreation activities that people just jumped into tells you that a whole load of people who were starving during lockdown because they didn't have it in their either work or home lives. I think there's going to be a general shift to try to introduce more recreation within our office environment and within our home environment. So I think the single story is over. I think people are going to have to begin to think of more, not just flexible, more imaginative ways of producing real estate that caters for this new shift and this, to accommodate this quantum leap. So, So, Bolaji, I can't answer your question whether it's a UV or a K. I know I saw. I saw.
I think Paul is quite right, Bolaji, because I think in my own perspective, that should be a long term, because I'm not looking at the mid-term or a short term, because from what Lagos State government, let's say Lagos State government, what they want to put in place now in the next couple of years is going to involve a lot of trillion, like they said. But I totally agree with Paul. There will be reconfiguration, remodeling, and there will be mixed use. These office property we're seeing now will turn to mixed use. We'll have people residential, we'll have people working in the same premises, and again, there will be new towns, new cities, which I feel whatever what's going to happen in the future, say another 3-5 years.
Okay. No, I think I agree with everyone here. I'm just so conscious. Sorry, I'm just conscious of the time that Tola, I'm just conscious of the time that we have at the moment. And, whilst not everyone, I didn't get the full answer to my LVU or K, I did get a good answer to my, what next? And I think as a final question, I just want to, it's a slight variation to what we've been talking about sort of recently. So, for example, we know that, potentially, and I use the word potentially wisely, that Joe Biden might become president of the United States, and the Democrats are talking about the Green New Deal. In Great Britain, Boris Johnson has just recently announced a green agenda with talking about new cars and everything else. Do you think that the green agenda will start to have an impact on how real estate professionals view opportunities in Nigeria and across the wider West Africa region?
So
again, this is open to everyone. This is open to everyone.
Well, I think Tola probably has the most breadth of knowledge across green, social, and commercial issues.
I'll just take a stand. So, to be fair, I mean, as a responsible organization that Standard Bank is, I think one can't deny, the need for greater sustainability in the type of projects that are funded, and the impact on the environment. And you're going to see that in terms of what the IFC is doing with the EDGE certification. We've also seen certain asset classes where they've been able to get some green certification as well. And what that relates to, and given the environment that we're in, it leads to operational efficiency, and that then speaks to your returns at the end of the day. From a tenant point of view, be it retail, be it offices, you do find certain tenants demanding if they were to choose between a building that has those principles or not, you'll find the multinationals going for greater sustainability and supporting that. So I think it will begin to play a more prominent role in how real estate evolves. Firstly, the technology aspect. So when we're talking about technology and real estate, a lot of that is embedded somewhat in ESG principles. So you begin to see that the operational benefit or cost efficiency benefit too is also profound. And my view is that it will play a greater role. And part of the evolution that we've talked about, the seismic shift, that is also part of it. So and from our funding point of view, beneficial. And if you're able to raise development funding, which is long term to the asset class, then that begins to move the goalposts in that direction. So hope that provides some context.
Yes,
it does. It does, and I think that also if Paul and Frank have any sort of want to make any answers, I think I do apologize, but can you limit your answers to no more than say 90 seconds? Thank you.
Yeah, okay, I'll limit mine to 60 seconds. So unfortunately, as politically correct as Tola is, so I'll say I will say one thing. Is the green agenda, is it important to the future of real estate and the world? Absolutely, yes. Will funds chase and will tenants chase more green buildings? Certainly. Will we get it in the short term in Nigeria, in West Africa? Absolutely no. That we have supply chain issues, we have cost issues, we have funding issues. It's not going to happen. For it to happen again, that seismic shift has to happen, not just from the funders, but also from the regulatory authorities and the government in terms of the ports and stuff. There's just too much to consider. There's no point producing anything that you can't sell. Because if it arrives produced at a cost that nobody can afford, apart from the internationals who, by the way, have left, right? Then it's dead on arrival. So my view here is, yes, I want it. Will we get it? I sort of doubt it, but I hope we do. Those are my quick thoughts.
No, thank you very much for that, Paul. And Frank, if you do have any final words, then that would be great.
The environmental, social governance is slowly but surely is growing in West Africa, and with the COVID-19 is accelerating, and more companies will be getting aware, and is expected to be more critical in selecting real estate investments in the next future. I think that is my take on that. So that's for me.
Okay. Thank you. Nice and brief. So I just want to thank all our panelists, Paul Owunebe, Frank Okosuna, and Tola Akinami, for their very insightful comments. And yes, so thank you all also for joining us in this conversation. And so we just want to wish you all a very good day.
Well, thank you very much. Good night, everyone. Bye now.
Thank you.
Okay. Thank you.
Thank you very much, Bolaji. Frank, Tola, I've learned a lot today, and this is a really
really interesting with you as well. So, Frank.
All right.
Thank you very much. Bye.